In this month's layoffs at Credit Suisse's New York office and Hong Kong office. UBS Group is planning to cut more than half of Credit Suisse's workforce. Most activities in Credit Suisse's investment bank in London, New York, and some parts of Asia are at risk from the cuts, according to people familiar with the matter. Ultimately, UBS plans to reduce its headcount by around 30%, or 35,000 people. According to two people familiar with the matter. Redburn analysts estimated a reduction of around 30,000 in their report on UBS this month. Due to the bank's merger with UBS Group, Credit Suisse plans to lay off about 80% of its investment banking staff in Hong Kong. James Jim Rickards is a renowned author, lawyer, economist, and finance expert who predicts the US dollar will falter in the wake of a new financial crisis. According to the expert, central banks have still not recovered from the previous crisis, while Russia and China have been buying gold at unprecedented levels. Silvergate Bank, Silicon Valley Bank, Signature Bank, Credit Suisse, and the potential failure of First Republic Bank are examples of the new global financial crisis. In spite of the UBS Credit Suisse shotgun wedding on March 19, the crisis may not be over. In the coming months, there is a good chance that there will be more big bank failures and continued stress on the system. The financial crisis comes on top of an emerging recession, as evidenced by shrinking global trade, declining manufacturing output, tightening monetary policy, continued inflation, and falling housing prices. It is similar to the global financial crisis of 2008 when a financial crisis and a recession combined. Investors are rightly concerned about this combination crisis, but there's another threat that may be more dangerous than a recession or panic that could make 2023 a trifecta for the ages. The threat is the possibility of the U.S. Treasury going broke and defaulting on government securities and other obligations. Congress has failed to raise the debt ceiling, posing this threat. The debt ceiling is a statutory limit on the total amount of debt the U.S. Treasury can issue. The Treasury issues more debt every few years to finance ongoing budget deficits. The total U.S. debt today is about $31 trillion. That's the amount of debt in the form of U.S. Treasury notes, bonds, and bills. There are tens of trillions of dollars in contingent liabilities from Social Security benefits, Medicare benefits, student loans and mortgage guarantees. For now, let's focus on the $31 trillion of bonded debt. According to him, the world was completely unprepared for the next crisis, which will be much worse than the previous two.
The dollar is getting stronger for some very bad reasons, meaning bad in terms of the macroeconomy, what probably lies ahead, what is probably telling us. But this is a conundrum for a lot of people because they look at it, the U.S. objectively, okay, our debt to GDP ratio is over 130%, the highest in U.S. history. Tons of research coming from, obviously Ken Rogop, but really Carmen Reinhardt, Vincent Reinhardt, and others, but many others, not just them, that says at those debt to GDP ratios, you can't grow. You can maybe refinance and muddle through, but it always ends either in default, which is unlikely because we can print the money, that much is true, or extreme inflation where here's your $1 trillion back, good luck buying a loaf of bread. So we'll see how that plays out, but the way it's playing out in real time is that the U.S. economic growth is incredibly weak. So we've got sky-high debt to GDP ratio. People talk unemployment close to an all-time low. Yeah, but even at 3.5% or so, that is extremely low. I mean, I go back to the 1960s, and that was low by the measures of the 1960s. But that completely ignores probably 8 to 10 million Americans who were perfectly able of having jobs and working, prime age 25 to 54 years old, who are not in the workforce. That measure is picked up in labor force participation rate, which is low. I mean, that peaked around 70% in 2000, up from the 1970s, and that was women coming into the workforce and other factors. But now it's down to around 62% and change. It ticked up a little bit in the last report, but it's still extremely low. It's never 100. I mean, there's always, you could be a homemaker, a student, they're retired, early retirees. There are a lot of reasons people aren't in the workforce, but not, taking 10% off a 14% decline from the starting place in over 20 years. So if you throw those people into they're not called unemployed because they're not looking for jobs. But if you threw them in, unemployment would be closer to 10%, which is a recession or depression level, actually. So, and I could go on, but the point is there are all kinds of signs of weakness. So, you know, if we have the deficit's out of control, and your trade deficit's out of control. So what's not to like? You look at all that and say, what, are you kidding me? I mean, get me out of the dollar. Go get anything else. Why is the dollar so strong? And the answer is, for this, you have to go behind the curtain. You have to look into what's called the plumbing of the international monetary system. And I had a discussion, and this goes back, this is 1980. So I'm an young, up-and-coming vice president of Citibank. That's back in the days when it was a bank before they turned it into a hedge fund. I'm like a 27 or whatever, a 28 maybe year-old lawyer, but I'm talking to Walter Wriston. It's a one-on-one conversation. He was, for those who don't know the name or don't recall, he was probably the second greatest banker of the 20th century after Pierpont Morgan. So I'll give Morgan the prize, but he left around 1910. And Wriston was the inventor of the Eurodollar. The negotiable certificate of deposit. Eurodollars are around a little bit earlier, but he took the CD that was your interest in the Eurodollar and made them negotiable and tradable. So I'm having a conversation with him, and I had just seen this movie. It's called Rollover, and it's, again, 1980. It's basically about the collapse of confidence in the U.S. dollar. And basically the idea was, remember, this is during the Arab oil embargoes and the Iranian oil embargo, and price of oil quadrupled in 8 years and all that. So the theme was the Arabs are taking the money out of the banking system and buying gold, and they're stashing the gold away. And this is the collapse of the financial system. And that was sort of the plot. So I said, hey, Mr. Wriston, what about that? Everyone took their money out of the system and bought gold. Wouldn't that collapse the system? And he looked at me like I was a new kid on the block, which I was. And he said, well, what you have to understand is that you can take your money out of the bank and you can buy gold. But the person who sold you the gold got the money and they put it back in the bank. So it doesn't go anywhere. It's a closed circuit. And of course, now I'm like, oh yeah, you're right. Of course, he's right. And he said, so the stability of the system doesn't depend on who sells what for dollars. Yeah, it affects exchange rates a little bit and interest rates with the price of gold. But he said the money it can't literally disappear. It has to go back into the system. It's a closed circuit. And of course, that's how the Eurodollar system works. But it presupposes that you can always borrow in the Eurodollar market. In other words, that closed circuit analogy is correct, provided the big banks are willing to lend to each other. So my example, if UBS was selling the gold and to the Arabs and they got the money and they put it back in Citibank Nassau, it's all good. But what happens if that money supply, now I'm talking about Eurodollars, actually shrank? And that is a heart attack in the global financial system. So now we're like, well, okay, what's going on? And believe it or not, there's a global dollar shortage. And when you say that, people say, wait a second, you kidding me? The Fed printed, the Fed's balance sheet in 2008 at the start of the global financial crisis was $800 billion. It was $4.5 trillion by the time we got to the end of the taper in November 2014. Then, okay, Yellen a little bit, but mostly Powell got it. They started quantitative tightening. They got it back down to around 3.5 trillion by the time COVID came along, and then boom, it's up to 7.5 trillion. Might have gone higher than that, and that's M0. M1 was exploding even more. So how could there be a dollar shortage? And that has a two-part answer. One is the money printing, at least M0, is irrelevant. It just doesn't matter, because how do they print the money? Well, the Fed buys securities from the primary dealers, and I was, after I left Citibank, I joined one of the biggest primary dealers, and I was there for 10 years, so I had a front row seat. That was back in the days when the Fed was actually tough on people. But my point is, I was a counsel of a primary dealer. We talked to the Fed every day. And so the primary dealers are the ones where the Fed, open market desk, the New York Fed does monetary policy. They buy, so they call up Goldman Sachs or Citi or whoever to offer me, 5-year notes or 2-year notes or whatever. Here's a price done. The banks send the securities to the Fed, and the Fed pays for it with money that comes out of thin air. But here's the part that matters. What do the banks do with that money? They give it back to the Fed in the form of excess reserves, the bank deposit at the Fed, in effect. So that money never went anywhere. It was created. It is on the balance sheet, but it all went to the asset side, which were securities, and it never went into the economy. So where does the money come from that runs the economy? If you or I want to go shop, well, it comes from the commercial banks. It comes from M1. Yeah, there is a multiplier, but that's in M1 and M2, which is created by the banks at will. And the Fed, those commercial banks have as much printing power as the Fed. They just do it differently by lending money or buying securities and paying for them with money that they create. So, and that never happened. It happened to some extent, but not nearly to the extent that what the Fed was doing with M0. So M0 didn't really matter. I mean, I hate to break it to people. Commercial banks do matter. Euro dollars do matter. That's how we run the system. People say, well, how can you have a dollar shortage with trillions of dollars in new money? You have $1 quadrillion of derivatives in the banking system as a whole. So that slice, whether it's the 7 trillion of M0 or a larger number, perhaps 24 trillion of M1, that has to support $1 quadrillion of derivatives. And by the way, for those who don't know, a quadrillion is 1,000 trillion. That's what a quadrillion is. So now, it's not dollar for dollar. Jamie Dimon would say, well, who cares? Just put up a little collateral. But you have to put up some collateral. And then you get into the collateral issues. Like, well, what's good collateral? The answer is, and this is what the banks are saying to each other. And this goes back to my conversation with Walter Wriston and the movie Rollover and all that. The banks are, and in fact, what happened in 2008, the banks are looking at each other saying, I don't want your corporates. I don't want your mortgages. I don't even want your 10-year notes. Give me, at a stretch, I'll take a 2-year note with a haircut, or what I really want are 30, 60, 90-day bills. I want treasury bills. And so you got to go out and get the treasury bills, and they're dollar denominated, which means you need dollars. So if you're Credit Suisse or Barclays or Hong Kong, Shanghai or Deutsche Bank, you don't live in a country that prints dollars. The U.S. does, but the European Central Bank doesn't. So there's this enormous demand for dollars, not because they love the dollar, but because they need to buy dollar-denominated collateral of a very high quality in order to pledge as collateral to support the quadrillion derivatives position, and plus any other trading they're doing. And so that's the clue. That's the secret that unlocks, or the key that unlocks the whole mystery, which is, it doesn't matter what the debt, for now anyway, it doesn't matter what the debt to GDP ratio is, the deficit is, the labor force participation rate, the weak. None of that matters. What's going on, not in M0, but in M1 and Euro dollars in particular, is a mad scramble for dollar-based, high-quality dollar-based collateral. And that's what's driving the dollar.